The truth? It's way bigger. There's a hidden war that's begun between the old financial system and the new one. And the crazy part is that almost nobody sees what's really happening because the headlines, they're all screaming about price volatility. But while that was happening, something else was unfolding behind the scenes, something way more important. We're seeing Wall Street quietly rolling out a new set of Bitcoin products that look like Bitcoin. They feel like Bitcoin, but they never actually touch real Bitcoin. Now, at the same time, MicroStrategy launched a completely different kind of financial engine, one that threatens the entire banking model. Now, these two moves collided at the exact same moment, and that's why the price suddenly moved the way it did. Now, this isn't about charts. This isn't about hype. This isn't about control. And once you understand what's actually happening, you're going to see this all through a completely different light. So let's go.
Let's start with the problem: transparency. Bitcoin and many blockchain systems are fundamentally transparent. Every transaction, every balance, etched into a public ledger. At first glance, that transparency is a feature. Auditability, censorship resistance, immutability. But the downside, which too many people forget, is privacy loss. On a public chain, your wallet addresses are pseudonymous, not anonymous. With enough data points and analysis, your address history can be linked to your real identity. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
The old ones that have been in place since 1913, and the new ones that Bitcoin just created. So let's just start right there. Now, when you strip all the noise away, the world's being pulled between two monetary architectures. On one side, you have what I'm calling the financialists, all right? That's the Federal Reserve, that's JP Morgan, that's the big European banking dynasties. It's the derivative markets. It's the entire scaffolding of the synthetic money that grew out of the backroom deal in 1913. And for over a century, they've controlled the collateral base, the yield curve, the price signals, and the credit system itself. And they do this not by owning assets, but they do it by creating claims on assets: eurodollars, swaps, futures, repo, synthetic layers stacked on top of synthetic layers. And that system gives them total control over the rails and the flow of money. Now, on the other side are what I call the sovereignists. These are nation states trying to exit dollar dependency. These are corporations tired of banking bottlenecks. These are individuals like you and I choosing self-custody and permissionless assets. Now, they all come from different motivations, but they share one thing: they're exiting the system that extracts from them. Now, Bitcoin was the first escape hatch, but it wasn't Bitcoin that actually triggered this new war. It's what came next. Because Bitcoin disrupted the narrative, right? Did that, but MicroStrategy or strategy disrupted the power. It proved that Bitcoin could actually sit inside capital markets as collateral. And that move, not Bitcoin's price, it's that move that triggered the war. All right, now to really understand this, let's jump ahead just a little bit. Let's talk about a new product called Stretch, STRC. Now, I've done a couple videos on this already, but most people still don't understand why this single product changed everything. Stretch is not just a bond. It's not another yield gimmick. It's not even a MicroStrategy innovation. Stretch is the first regulatory compliant Bitcoin collateral engine. What that means is basically it lets everyday savers through normal brokerage accounts earn yield backed by Bitcoin without ever touching the banking system, without ever touching repo, without touching derivatives, without touching ETFs. And the yield, well, currently right now it's paying 10.75%. The competition, well, banks, they're paying you what, 0 to 1%. Money markets are paying 3 or 4%, depending on the liquidity. Treasuries around 4%. So Stretch blows them all out of the water. And as great as that is, the real threat isn't even the yield. It's the monetary feedback loop that it creates. You see, when you invest, Michael Saylor, strategy, buys real Bitcoin. That tightens up the supply. When the supply tightens, Bitcoin's price rises. Then strategy's collateral base strengthens, which means their cost of capital drops, which then means more Stretch demand comes in, which then means they buy more Bitcoin. So it becomes this self-reinforcing flywheel, this reinforcing scarcity engine. And here's why the financialists are panicked about this. You see, traditional banks can't replicate this. They can't use Bitcoin as collateral. They can't settle in Bitcoin. They can't rehypothecate it 20 different ways. They can't inflate it, can't freeze it. They can't fabricate new claims. So for the first time in modern history, savers had a way to bypass the banking system's rails inside of the regulatory perimeter. And the moment that became possible, that's when the first strike hit. Now, of course, the attack, it didn't start with headlines, right? They didn't announce it. Of course, it started very quietly. In July of 2025, there was a single move by JP Morgan's prime brokerage division. They raised the margin requirements on strategy from 50% to 95%. Now, to put that in plain English, if you wanted to buy, let's say, $100,000 of MSTR, the stock, you'd have to put up $95,000 of cash. You could barely borrow. So what that did is it suffocated leverage. And they did it right before Strategy announced their $835 million Bitcoin purchase, which was its largest in 4 months. So then you have all these like hedge funds who were long MSTR as a Bitcoin proxy, all of a sudden were forced to unwind their positions. Now, what do you think happened? Well, unwinding, selling. So then selling pressure hit immediately. And then of course, the price of MSTR collapsed immediately. Now, this wasn't just a system-wide adjustment here. JP Morgan didn't do this to other stocks like Tesla, Nvidia, Coinbase, didn't do it to other high volatility stocks. They only targeted MSTR, right? And then, of course, then came the synthetic counterstrike. So on November 25th of this year, JP Morgan filed with the SEC for a leveraged Bitcoin-linked structured note tied to BlackRock's ETF, the IBIT ETF. Now, these things, they're the perfect example of how Wall Street uses this old playbook. So investors pay $1,000 per note. If IBIT is above a preset level in December of 2026, then JP Morgan can call the note back and pay you $160. That means you would lose 84% of your money. If it goes to maturity in 2028, you'll get 1.5 times upside on Bitcoin. But if it drops 40%, you lose most, or maybe all of your principal. So what this does, it gives you the illusion of Bitcoin exposure, but really what JP Morgan is doing is they never buy any Bitcoin. So there's no supply removed, no collaterals created, there's no scarcity loop that's being formed. It's synthetic shadow. It's the same playbook that they use with gold. And it wasn't just JP Morgan, right? We see funds like Carisdale and Chanos. They are running coordinated long Bitcoin and short MSTR campaigns. Now, by November 2025, there was 27.5 million shares short, over 10.5% of the float, which was the highest amount that we'd seen in a year. Then the next piece came. MSCI stepped in with the index exclusion threats that could force up to 8.8 billion in passive outflows. And right when all of this hit, when it all hit the news, MSTR failures to deliver shot above 180 million, signaling massive structural pressure. That's not competition, right? That's a coordinated suppression campaign. It's the same pattern they used against silver back in 1980 when COMEX raised margin requirements on silver to 100%. They did that to break the Hunt brothers who were trying to corner the silver market back then. Now, it was a different asset back then, but it's the exact same playbook.
Now, what about Monero? Monero takes a different practical approach. It obfuscates transactions by default. Every transaction generates multiple decoy outputs, ring signatures, and stealth addresses, effectively creating hundreds or thousands of plausible histories for any given transfer. In practice, Monero is far more private than a raw Bitcoin transaction, and even stronger than optional mixers.
But let's jump back in. And to understand what JP Morgan's doing with Bitcoin, you have to understand what they did with gold. Right? So let's go back and sort of look at it through that lens, because the entire modern gold market is built on paper, not on metal. On COMEX, for every single 1 ounce of real gold, there's roughly 100, maybe more, 120 ounces of paper gold. And that paper gold is then traded through futures contracts. We see daily volumes often exceeding over 200,000 contracts, which is 20 million ounces of paper gold. And that's at the same time while COMEX vaults only hold 20 to 30 million ounces available for delivery. So that basically means that the price is not being set by supply and demand of physical gold. It's being set by paper claims that almost never settle. Right, then you have the LBMA, the London Bullion Market Association. They're private, they're opaque. It's a cartel of banks like JP Morgan, HSBC, UBS, and Goldman. And they move gold through these unallocated accounts where nobody actually owns specific golds. The structure basically allows them to do like naked short selling, unlimited rehypothecation, synthetic exposure, and a price governed entirely by paper instruments. Now, when MF Global collapsed in 2011, clients with what was called allocated gold, they learned it had been rehypothecated several times, and so they didn't get their gold. They didn't get their gold back. Now, they did get cash, but they didn't get the bars, right? This is the system that Bitcoin was born into. It was a system that was built on claims, not collateral. And that's really the key here, right? See, Wall Street doesn't control assets. What they control is claims on the assets. So they don't have gold, they control synthetic gold. Not silver, but synthetic silver, synthetic treasuries, synthetic credit. So of course, that's what they're trying to build on top of Bitcoin, synthetic Bitcoin. Because if Bitcoin stays inside their paper system, they can win. But if Bitcoin becomes collateral, if it stays real, their entire model breaks. And that's exactly what Stretch threatens. All right, so now if all of this starts to sound a little familiar, because it is, right? We've lived through this exact kind of transition many, many, many times. Let me just run you back through like the last 100 years real quick. I know you love the history lessons. So if we go back to like the early 1900s, the United States was shifting from a decentralized agrarian financial system to a centralized industrial one. Now, the old model, it couldn't handle the scale anymore, right? So like local banks, they had inconsistent currencies, fragmented credit markets, and none of it worked for a nation that was suddenly industrializing faster than the monetary system could keep up. Now, every time the old system was threatened, the response looked the same. Centralize the power, control the narrative, and suppress anything that stands outside the new structure. Let's take medicine, for example. In 1910, Rockefeller funded the Flexner Report, which redefined what legitimate medicine was. Now, not through science, but through funding. Natural healers, homeopaths, herbalists, they are all labeled quacks. Medical schools that didn't align were defunded. They were shut down. By 1920, half of all medical schools had disappeared, and the pharmaceutical model had complete and total control over the narrative. Now, we saw the same thing happen in the education system. Rockefeller's General Education Board pushed standardized factory-style schooling. Now, if a district didn't adopt the model, didn't get any funding. By 1920, the entire country was running the same top-down curriculum. We saw the same thing with agriculture. We saw small farms collapsed as industrial agriculture got financing, they got chemicals, got equipment, and also got subsidies tailored to the big operators. So then the food supply centralized into a handful of corporations, and then of course, the money. The Panic of 1907 gave elites the pretext to do what they had been planning for years, which was centralize monetary control. By 1913, we had the Federal Reserve. Now, that was drafted at Jekyll Island, and it was built by the bankers. It was designed to move authority from local banks to a centralized insulated board. Now, with this pattern, right, when the system is threatened, we see it centralize the rails, control the story, suppress the alternatives, and now Bitcoin. And now specifically Bitcoin as collateral, that's the new threat. Now, by this time, the playbook can't work the way it used to. And here's why. And this is where everything really comes together, because the real battle isn't Bitcoin versus the dollar, right? It's not Bitcoin versus Wall Street even. The real war is over the rails, the systems that move value into Bitcoin and move Bitcoin into credit. Control the rails, control the future monetary system. In Strategy, through their product STRC Stretch, they expose something Wall Street never wanted the world to actually see, that Bitcoin can actually function as pristine collateral inside capital markets. And once that happened, the financialist model, it all started to crack apart. You see, for over a century, their power came from their ability to multiply collateral. So gold, well, they built a system of 100-to-1 paper claims. Dollars, fractionalized lending. Treasuries, rehypothecated through the banking system. But Bitcoin breaks that advantage. You can create synthetic Bitcoin exposure, but you can't create synthetic Bitcoin collateral because every coin is tracked. Every movement is visible. Nothing can be quietly inflated. And the markets Bitcoin trades on, global, 24/7, borderless, right? And so they can't be shut down. Even when volatility threatens the structure, there's no, close the exchange. There's no circuit breakers to halt trading. There's no, allow liquidations only. If the US or any other country tried to tighten the rails, then capital just goes offshore. If Wall Street tried to cage, Bitcoin inside synthetic products, then sovereign buyers can just acquire the real thing. And that's why stretch is such a threat, right? It created this loop. It created this loop that the old system, it can't replicate, right? When Bitcoin rises, MSTR's collateral gets stronger. The cost of capital goes down, which then means they can buy more Bitcoin. Then the float tightens up and then Bitcoin goes up again, right? It's that scarcity engine, one powered by real Bitcoin, not synthetic exposure. Now, JP Morgan's IBIT linked notes, they don't tighten the float. ETFs don't strengthen Bitcoin's collateral base. Futures don't remove supply. Only real Bitcoin does. And that's why no matter how aggressive the old system gets, margin hikes, synthetic shadows, index exclusion, threats, whatever, right? They're fighting monetary physics. And in the real world, physics always win. All right, so let's bring this all down from the macro to you and I, to personal, because all of this, the pressure campaigns, the synthetic products, the regulatory maneuvers, it all ultimately lands in one place, which is how we save our wealth, right? The old system simply isn't designed to reward savers anymore. Banks pay nothing. Money markets only work if treasuries behave, and even then they're below the rate of inflation. Treasuries only work if inflation stays low. We've already talked about many times how that's not going to be the case. Multiple cycles where we've seen where it doesn't stay below. And when the system gets stressed, the same people who created the stress change the rules, right? You're expected to just absorb that, but the margin hikes, they hit you. The synthetic Bitcoin notes, they're aimed at your returns. The index threats, your retirement accounts. And it's not paranoia, it's the system defending itself, because your exit becomes the problem, right? In every monetary shift in history, the people who stayed in the old rails, they're the ones that paid the price. While the people who moved early, they benefited for generations. So you're living through one of those transitions right now. And we can see this, not in hindsight, not in some textbook. We're seeing it happen in real time. And the question isn't, is this happening? The question is, are you positioned for it? Am I ready for it? Because for the first time in 110 years, you're not trapped inside the old financial rails anymore, right? Today, you don't need permission. You don't need a policy change. You don't need a bailout. You don't need the system to fix itself, because none of these attacks on strategy or attacks on Bitcoin products, none of the margin hikes, none of the index threats, none of that is happening because Bitcoin is weak. It's happening because Bitcoin is too strong for the old system to ignore, right? The proof is in the behavior. We can see that BlackRock launched the fastest growing ETF in the history of ETFs. And it wasn't for bonds, it wasn't for stocks, it wasn't for gold, it was for Bitcoin. Fidelity jumped in, Franklin Templeton jumped in. Now JP Morgan, the same JP Morgan raising margin requirements and targeting Bitcoin treasury companies, they're now racing to launch a Bitcoin-linked structured note. So just ask yourself, why? Well, the answer, because they know exactly what Bitcoin is becoming, right? The new collateral layer that's going to absorb more liquidity than anything else in the financial system. And so this isn't fear, right? This is demand. It's demand from the biggest institutions on earth. And what they want, or rather what they don't want you to understand, is that in every Wall Street product, every ETF, every structured note, every synthetic instrument, they control the rails. They capture the fees. They take the convexity. They siphon off the upside. Yes, you get some exposure, but they get the economics. You don't have to buy the synthetic version note. You don't have to let a bank hold your hand. You don't need a structured note or a custodian or derivatives desk. You can own Bitcoin directly, which is the real asset, the scarce collateral, the thing that Wall Street is scrambling to wrap and repackage and skim away from you, right? That's the real payoff here. The financialists, they're not fighting Bitcoin because it's a threat. They're fighting for a piece of it, right? Because it's the next system. They're trying to control the rails because they know where the liquidity is going. But you don't need their rails. Bitcoin already gives you your own. And the people who understand that part early, the people who position themselves before the transition becomes obvious, they're the ones who come out on the other side of the shift on the winning side. And that's why all of this matters for you, not in theory, but in your actual financial life. Because the key is you're watching a once in a century, maybe a once in 5 century monetary transition unfold in real time. And you can either observe it from the sidelines or you can build a system that positions you on the winning side. All right, now that's one of the reasons why I'm hosting the live Wealth OS Accelerator event January 7th through 9th. And this isn't a webinar, right? This is a 3-day interactive live virtual event training where I'm going to show you the exact operating system I built for myself, the same system that lets me navigate chaos, position to get upside and stay completely independent from the rails that are breaking. And so if you come hang out with me for the live event, here's what you're going to walk away with: a step-by-step plan for how to build, protect, and grow your wealth during the transition and not react to it. We'll simplify your financial world so you're not guessing, hoping, or depending on someone else's rails. You'll walk away with a strategy for turning the Bitcoin and tech shift into real, practical upside. And most importantly, you'll walk out thinking like the architect of your own wealth engine.
Finally, the ethical and philosophical point. Privacy is not just about hiding wrongdoing. It's about the right to transact free from perpetual surveillance. In an age where governments and corporations increasingly track behavior, financial privacy preserves a baseline of autonomy and fungibility that money needs to function equitably. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.